Since it's very difficult to compare different companies because of size, companies will tend to look at, or analysts will look at, the same company over time and try to make comparisons that way. And the two ways that we can do that is through either a horizontal or a vertical analysis. Horizontal analysis is also referred to as trend or common base year analysis. And vertical analysis can also be referred to as common size analysis. So we're going to look at doing this here again for ProofRock, and this will be the second step in a financial analysis of a company. So you'll see we've got the balance sheet and we've got 2014 and 2015 data here. So the first thing I'm going to do is I'm going to do a horizontal analysis, and you see here in column H, as I mentioned before, I've calculated the change year over year. So I've just taken the 2015 numbers minus the 2014 numbers. Now, if I take that and divide that by the base year, and we always assume that the last year is the base year, so 2014, I can see the increase or the trend in that account. Now, your book also looks at this as really just taking the number in 2015 divided by the number in 2014, and you'll see it gives you a multiplier. I like to see the percentage better, as that tells me exactly how much that account has increased. So if you go ahead and you do that for one account, so you take the change divided by the base year and you do your drag and drop, it'll copy that formula right down to all of the other accounts. And that's how you would do your trend or horizontal analysis. And once you get your numbers, the next thing you're going to do is you're going to look at them and kind of pick out the ones that are the biggest. So for instance, we see that cash increased by 17%, accounts receivable increased by 14%, notes payable decreased by 15%, and long-term debt decreased by 14%. And then another big one would probably be these two. Okay? And you'll see that this really does tie into what we've already said from our sources and uses analysis. Our current assets are increasing, so we've got more money coming in accounts receivable, more money coming in cash, and we're using that to pay off our current liabilities and long-term liabilities. And we also had an increase in stock. So not only did we perform fairly well this period, we also sold some additional stock. So we had, a large kind of influx of money coming into the company. Now, that's just how you can compare year over year. Now, another way is to look at this in terms of common sizing. So common sizing says that we're going to take each and every account on the balance sheet and divide it by the total assets. So the denominator stays the same as B15 or total assets for every single one of these. And the reason we do this is that sometimes cash might look like it's been a huge increase, but maybe total assets increased around the same amount. And so it's not, a huge increase. So we like to look at everything as a percentage of the total. So now you'll see if we do cash, 84 divided by 3373 represents 2.5%. And that's, pretty close or pretty in line with the 2015 numbers. Now again, you would go through and you'd look at and see if there's any huge differences. So you see net plant and equipment, because it's such a large number, that number from a common size perspective, even though it went up 5% year over year, as a percentage of total sales, it's actually lower. So that's an interesting thing to point out. As well, you'll see accounts payable went up 10%. It also went up as a percentage of our total liabilities and equity, or total assets, which would be the same thing. Notes payable went down. It also went down from a common size perspective. Long-term debt went down. It also went down from a common size perspective. Common stock went up 10%, but as a common size number, it wasn't that huge of a difference. Retained earnings went up, and it is quite a significant increase year over year. So that's how you would perform a horizontal and a vertical analysis on the balance sheet. Now, we can also do this from an income statement standpoint. Now, in this case, we only have the income statement for Prufrock for 2015. But if we had this information for 2014, we could compare. And some of the key areas you'd want to look at would be, gross margin. So what is the percentage of cost of goods sold as a percentage of total sales? Or you'd want to look at, have the interest costs significantly increased year over year? And if they have, maybe it's because you've taken on some additional debt. Could also look at the taxes and how much taxes the company's paying, or how much depreciation is and how much that has increased or decreased. Presumably, this depreciation number would be higher than last year because we did invest in more long-term assets. So these are some of the areas you would look at from a vertical and horizontal analysis. And always remember, from a horizontal analysis standpoint, you're going to calculate the change year over year divided by the base year. And from a vertical analysis, you're going to take every item on the balance sheet as a percentage of total assets and every item on the income statement as a percentage of total sales.